Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Friday morning. This Friday morning, we got the PCE data, and this is where the Federal Reserve is going to recalculate, reconsider, if at all, what the numbers higher or lower mean to the future for rate cuts. So this is how the future for rate cuts basically is. If the PCE is flat or cooler, lower, then there's room for the Federal Reserve to continue to cut rates. If the PCE is a little bit higher, hotter, right, that then limits their options in terms of cutting rates, because cutting rates tends to do what? Increase inflation. That's not what they want. So today's data was for the most part flat. There was one month-over-month number that was slightly higher. Consumer spending was higher. So for the most part, the bulk of the data, and it's not just one headline PCE number, it's about 6 of them. And for the most part, I believe 4 of 6 of these were pretty much in line with the month-over-month forecasts and the year-over-year forecasts. So there wasn't a lot of action other than a slight drift lower in the indices. We'll get to that in just a little bit. The idea that today's PCE would have any effect on whether or not we're going to continue to see rates, I'm going to go by the data. June has always been up in the air. The June 18 expectations have not been set, right? They're more likely to see a rate cut, but they're not high probability. They're just the most probable. And then when we get out to the July 30 meeting, this is where that rate cut is priced in. So broadly, it's a really interesting two-way communication device, these Fed fund futures. The Federal Reserve, believe me, they know what these numbers are. And we, you and I, traders that are trading Fed fund futures, whether you trade them or not, it's traders, are communicating to the Federal Reserve, we expect a rate cut. We're expecting rate cuts at least by July, if not June. And the only way that the Federal Reserve can keep from creating the kind of disastrous panic that, by the way, this Fed head has done before in Q4 of 2018. He ignored this. He was broadly expected to pause, and he hiked anyways. Who remembers Q1 of 2019? That was Powell ignoring this. And so a very young, that was probably early in his tenure as head of the Fed. He's not going to do that again. Unless he wakes up one morning and chooses violence, and I think he's far more measured than that, he's not going to do that again. So between now and June 18, between now and July 30, he has a couple of choices. He can send his Fed member minions out, and they can start to talk down these expectations. But one thing that's really interesting is these expectations have been pretty much like this the past 2 times that Jerome Powell has had the opportunity to talk things down. And today's PCE really should not change that at all. Like I said, one of the numbers was a little bit higher, a little bit hotter. The Federal Reserve is probably not going to make any significant monetary policy messaging changes based on the data we're seeing for the PCE. By the way, the next big data point that they're going to be dealing with is non-farm payroll. So that's going to be the first Friday of April. So that's going to be the next big hot zone. Remember that the Federal Reserve has a dual mandate. One is inflation, and the second is employment. Now, this morning's drift lower can't be a complete shock because shortly after 2 a.m., price action sunk below the previous session close. So the previous session cash close, a 4 p.m. Eastern close, is something I call the line in the sand. And this line in the sand, when price action is below it, tends to, the way that I conceptualize it is, we have the equator circling the earth. Above the equator is the northern hemisphere, below is southern. Well, it kind of works that way in the equity markets. When we're below this line in the sand, this equator of the 4 p.m. previous cash close, That's the bearish hemisphere. And you'll notice things tend to act bearishly, lower highs, lower lows, when we're below that bearish hemisphere. Now, there could be news, unscheduled or scheduled, that could buoy us above those levels. But for the most part, when below the previous session close, we're in that bearish hemisphere. The next thing that I want to look at is the reaction with bonds. All right. And bonds moving higher means rates are going lower. Now, bonds are not reacting to the end of March. Bonds are reacting to at very soonest 3 months from today. And if you think about, let's just call it April, May, June, 3 full months, lands bonds right now really pricing in July, maybe late June, early July. So rates are going lower and bonds are at least 3 months ahead pricing in what's going to happen approximately a quarter from now. What are we expecting to see a quarter from now? Lower rates. Bonds are seldom reacting to the now. They're reacting to the now, but projecting at least 3, sometimes 6 months out. So bond yields moving lower are, the way that I would look at this, if this continues, is an expectation for the Fed to cut come early summer. If you want to call it, would June and July be considered early summer, early to mid summer? And that's where bonds are. And I would like to see this. If the cuts are on, I would like the bonds to not be playing a game of chicken with the Federal Reserve, sort of a liar, liar, pants on fire, where the Fed can say one thing and bonds respond another way. Remember, bonds are always about 3 months out. So this is pretty good confirmation for those lower rates to come. All right. So as always, gang, if you have any questions, feel free to type them in. Let me just open up the charts a little bit bigger, and let's take a peek at some daily time frame looks. I put a video out on Tuesday, kind of asking a simple question. It wasn't about projecting and crystal ball future tell, but my thought is, for the most part, we're going into a bottoming pattern. Is the bottom in? Am I expecting the S&P to sell off below a 10% level? Likely not. And here's why. Everything that you and I are going to talk about, whether that be forward earnings, whether that be GDP, whether that be the way in which whatever news we're dealing with now, tariffs, whatnot. If we're talking about it, here's my guideline. It's already been discounted, right? A lot of the sell-off through February and into March was a tantrum around a lot of those, whether that be geopolitical, which I don't think has been the bulk of it. Most of it's probably fairly political and around tariffs. And if we're already seeing the sell-off, if we're already talking about it, it's discounted, gang. So I'm not in any way factoring in those headlines and those narratives going forward. The equity markets, the futures markets, the Forex markets, any market is a forward-looking machine. It takes what it knows and it reacts to it now, right? It's always trying to look around a corner. So by the time we get to whatever that thing may be, I know a lot of folks are waiting on Rog. What about April 2nd? We've been thinking about April 2nd for 6 weeks. It's discounted unless the thing is a surprise, right? So we discounted sort of this reciprocal tariff narrative. We've discounted to some degree some geopolitics as well. All the things that we're talking about are priced in. If they're worse, right, whatever the narrative was, if the narrative is even worse, now we could see a pullback below 10%. But barring that, we're probably looking at maybe a very slow and volatile and possibly painful, patience. It's going to be testing our patience. I find that painful, right? We're really going to have to deploy all of our discipline and all of our process. But yeah, very much based on those things, based on the data, based on my showing you that the Fed rate cuts, based on the bonds, yeah, I'm going to look at this as largely the bottom being in a bottoming process. So this is when I want to start shopping for things that I'm going to regret 12 to 18 months from now not having bought. Part of our sector secrets mastery is having a long-term position trading portfolio. And that doesn't mean I'm buying something, calling it long-term and scaling out of it 2 and 3 or a month later. This is really months to years. So be careful what some people call long-term, or at least define what that means. Hey, when you say long-term, Rog, what do you mean? If you talk about a long-term position trade, what does that mean? It's probably as close to investing as I get. I'm really not an investor. I apply even my trading methodologies to something that I plan on holding for 20 years, right? I'm not a buy and holder. I want a risk plan, a target, and an entry plan. And that to me is trading. And again, regardless of what you call it, like I joke and say, you can call it a bologna sandwich. I'm less concerned about what we call it and more concerned that we can have an agreement as to what it means. And for me, trading, position trading is that 6 month to years time horizon. All right, we've got positions that we've built in the Sector Secrets Mastery that are position trades that we've had since 2022. And they're up nicely. And if they don't do what we need them to do, we cut them, right? So that's really important. I was actually looking at, I have my little journal here. I have the bulk of the positions that we've been building. I'm going to write them down. And I think we've had 17 setups. So in the last 2 years, 17 different longer term setups, 15 of them triggered. Arguably 16, that one got really, really close, but I don't count close as a trigger. So 15 of the 17 alerts triggered. 13 of the 17 are still producing positive results for us, and they're still being held. So that means 4 of those, right? Four were either, I should say if we had 15 of 13. So 2 or 3 of them were stopped out. But ultimately, what I want to remember is I think a lot of traders view investing as forever and ever. I'm never going to cut it. There's no risk management. And that's what I think hurts a lot of quote unquote investors or position traders, because there's no cutoff for, well, I like the idea then, but is it really doing what I think it should be doing? Am I really using my capital in a way that's helping grow my account? So those are things to keep in mind as well. If I'm talking about a bottoming process, if I'm talking about why using bonds, using Fed fund futures, using the 10 and 20% pullback guidelines, this is why right now, and probably for the next couple of months, we should have a decent window to start looking at this, because we're not really going to see those rate cuts until June, July. Plenty can happen between now and then. I know a lot of traders want to know how Q2 is going to respond. I know a lot of traders want to know about earnings. Let me just say something a little controversial. Earnings don't matter, gang. I know the top of their head exploded. Gang, believe me, earnings do not matter. Go look back on earnings and general trends and compare 2 things. Does it matter more what the Federal Reserve is doing, or does it matter more about earnings? Earnings have been reduced, sadly, to a spectacle of volatility that affect for about 2 to 3 days most intensely, and sometimes obviously can send a stock significantly higher or lower. Unless that stock is a major weighted component of the indices or of the sectors, earnings don't have the impact. Gang. They have plenty of volatility, and some folks like to trade it, but earnings are not as important as what the Federal Reserve is going to do. And look, it's my opinion. Agree, don't agree, that's okay. But I'm always going to share with you all without any polished. This is what it is. I want to give it to y'all very raw. Earnings do not matter in terms of that longer term. How many stocks are, and by the way, ludicrous price to earnings ratios don't matter either. A lot of times people say, Rog, this stock is trading this time's earnings. It doesn't matter. If people want the thing, it's demand. It doesn't matter, right? So us questioning why they want it, we're going to miss out on a lot of opportunity. So a lot of these conversations that happen on television where this stock is trading, forward earnings this many times and that's a knock against it, who cares? Because if people want the thing, they want it. Now, the other thing I'm going to tell you that's going to be difficult, and again, take this and measure it against whatever works for you, but never are you going to buy a 10, never am I going to buy a 10 or 20% dip in a stock on good news, right? Buy the dip never comes with the good feeling of everybody wants it, right? If we want to find something that's not in a downtrend, we want to find something that's above key levels of support, preferably with a few key things that are telling us that volume and attention is there, because we're never alone in a trade that works, but it's never going to be with good news, right? So keep that in mind as well. All right, a couple questions here. Let's see. Ren says, thanks for explaining PCE numbers. Yeah, everything that I look at in terms of data, right? Everything in terms of data is what the Federal Reserve is going to focus on. All right. Another question here is, and thanks, Ren. Given tariffs don't start till after April, there is no way for the Fed to know the impact on inflation. So how can we rely on the Fed watch? Do you think this is the first rodeo for the members of the Federal Reserve? Do you think they haven't thought ahead as to what it could be? That's their job, right? That's their job. By the way, us as traders and investors, this is not our first rodeo either when it comes to tariffs. So I don't know why people are acting as if this is aliens hovering over the earth and we've never seen this before. We have. So I'm going to trust that history may not exactly repeat itself, but it sure does rhyme, right? And there's no harm in waiting to see what happens after April 2nd. There's no harm at all, right? It's just a measurement of, can I manage risk before April 2? I'm not piling up on entries between now and April 2, but I am readying myself for these buys, because again, the mindset isn't, are tariffs going to be negative or positive? We've been thinking about that for 6 weeks. Unless that narrative is so much worse than what was already discussed, which so far they're not, chances are the bottom is in, right? Now, does that mean that we're not going to have volatility? Of course not. Does that mean that we're not going to see maybe some stocks continue to struggle? Stock selection is going to be really, really important. Sector selection, index selection is going to be really, really important. So that's where, is it going to be easy? No, but I know, based on doing this for over 3 decades, when I see 10 and 20% pullbacks, and I don't at least start building a shopping list, I'm going to regret it a year to a year and a half from now. So please also keep in mind, I'm not talking about 6 weeks from now. I'm barely talking 6 months from now. And I want to be able to be in this maybe, 6 years from now. That's the mindset, right? So again, I like to give you all the details so everyone can make up their own mind. Nobody knows what happens next, right? We just try to work the probabilities. Let's see, what else do we have here? How do I feel about straddles and strangles? It depends on the underlying environment. Fresh Fred, I will tell you this. I'm not a fan of selling option premium, mainly because it demands that a trader have a margin account. And then if that margin account is below $25,000, now they have the pattern day trading rule. And that really curtails the number of trades a trader can make in a margin account under $25,000. I like strip and strap straddles. And that is only long calls and long puts, and that can be done in a cash account. So if there is a strategy of multiple options designed to allow me to benefit from a directional bias, but then sort of put an option-based safety net instead of maybe a stop loss, that's a strip or strap straddle. And it's usually a 2-to-1 put to call or 2-to-1 call to put ratio with a directional bias. And that's an old school style that I've used for many, many years. It's about the only time that I'll use options as a stop loss or as a safety net for risk. Strip and strap straddles. All right. Let's see. I think I'm out of time. So thank you as always, gang. Thank you for the questions on PCE. Thank you for the questions on tariffs. Thanks for the questions on strangles and straddles. At the end of the day, gang, I do want to mention, nobody knows what's going to happen next. We work you and I have chosen to do something where we're always going to have incomplete information and we don't know what happens next. That's why risk management is the number one job. That's why thinking probabilistically is the number one job. And I'll tell you, the person I love reading about this topic is Annie Duke. If you want a good read over the weekend, go pick up something by Annie Duke. Gang, we need another trading book like we need a hole in the head. Go outside of trading and look how people manage risk, right? Go outside of the world that we're in, which give or take, everyone's going to say 10% of the same thing. And oftentimes people are just regurgitating what was said sometimes decades ago. There's very little new in the trading world. It's just people taking things they heard and making it their own and wrapping it up in a new package. That's fine too. I found that if I go outside of the trading world and read about how people manage risk as business owners or as a professional poker player like Annie Duke, it's a whole lot more interesting, and B, it's going to open my mind to other ways to do things. And that's going to give me an edge, because when everyone else is doing give or take the same 10% of thing, give or take 10% the same things, and we could do something a little different, there's a huge edge there. Have a wonderful weekend, and I will see you all next Charts and Coffee. All right, gang, caffeinate and dominate. I'll talk with you soon.